All right, here we are again. So it's Tuesday night, and what we're going to do first is go over the sample midterm, which covers chapters 1 through 6. And then when we're done tonight or first thing tomorrow, I'll post the actual midterm. You can have a couple of weeks to do it. It shouldn't take that long, but you might want to take some time with it. And there's no rush because we have 3 or 4 more sessions, I believe. In fact, why don't we look at the calendar for a second? Let's see. We have the 13th. I think our last night is the 27th, but I'm not positive. It's either that or the week after, but let's see. Well, I'll tell you what, there's only one way to resolve this. How about if we look at the syllabus? So hold on one second. There we go. No, that's not it. Syllabus. Here it is. Here it is. Okay. So this will do it. This will have it. It's way at the end on page like 500. No, those are not dates. There's 10 sessions though, for God's sake. No, it says on the top. Oh, it does say July 27th. Okay. So we keep an eye on where we are now. Let's see now. We've got assignments, which we've only had a few so far, but we'll have a few more, and that will take care of that. The midterm is chapters 1 through 6, which I will hit, like I said, I'll post later on tonight. And then that, of course, implies that the final must be the rest of the course. So that would be chapter 7, where we started with bonds, up to the end, which is 14. Okay, 15. Sorry, 15 and 16. All right. So it sounds like there's some gaps in there, but now when we're done, the last night is the 27th. That means they usually give me 3 business days to have the grades in. So since this class meets on a Tuesday, that would tell me that they would need the grades by, let's say, the following Monday, which would be August 2nd. So, I'll hand it out, and then I'll try to give you as much time as possible. And so that's where we're going. So tonight we're going to do the sample midterm, as it's called, and then we'll finish chapter 10, and then we'll get through the rest of 11, or some of 11. 11 is fairly long, so we may have to save some of that for next week. And then we're going to go into the last section of the course is all about derivatives, specifically forwards and futures, and options. And it looks like this last group is swaps, foreign exchange swaps. Okay. So anyway, don't worry, we'll get it all done. Right now, why don't we get through the sample midterm? And you'll see it's pretty straightforward. And then we can carry on with the new material. And then I'll assign 1 or 2 more problem sets, and then we'll have our final, and then we'll be done. Okay, so it's kind of hard. This summer is very disorienting. It's hard to tell how much progress you've made. During the school year, we have like 4 months. Here we had something like 8 weeks. And so that does make it a little bit more difficult to keep track of what we're doing. But so anyway, let's get this going. So sample midterm. Here we go. All right, so the way it's set up, now remember, this is 1 through 6 only. So it takes us up to our discussion about monetary policy in the Fed. So there's 25 short answer questions just two basic problems. The second one is a little bit of algebra. The first one is really just graphs. So I don't think this will take very long at all. But I'll give you a couple of weeks anyway, just in case you need it. The final exam will be a little bit more involved, but it'll be very similar in the sense that there'll be a lot of fill-ins, and there will also be some problems, which will be a little bit more complicated because we're including our discussion there about not only bonds, but also derivatives. So that'll be a little bit more involved. All right, anyway, let's see what we've got here.
Professor, I don't mean to
Yes.
interrupt, Maria. I have a question. You said that there were assignments. I don't remember seeing any assignments. Did I
Oh,
miss that?
wasn't there, didn't I ask you to do the chapter 3 problem set? I thought I did.
Oh, when was that due? When do we have to? I
Oh,
apologize. That was my mistake then.
don't worry about the due date. Just send it in when it's ready.
Oh, okay.
We'll make the due date for the problem sets the last day of the class. How about that?
All right.
Yeah,
Thank
don't
you.
worry. Yeah, no, you didn't miss anything.
Okay.
All right. Well, while we're at it, let's go back and look at. I'm pretty sure that that's the only one that I
Okay.
announced so far. So I'll add a couple more. I think 3 was the only one. I remember what happened now. We had the holiday. That's what
Mhm.
it was. And I had decided that with a holiday, maybe we shouldn't have any assignments. So I'll tell you what I'll do. I'll make an announcement after we're done. And I think so 3 is the structure of interest rates. Some of these don't really lend themselves very well to problem sets. That's what part of the problem is. 7 definitely does, though. We'll definitely have a chapter 7 problem set because it's bond pricing. And chapter 8, that also has, okay, so here's what I'm going to do. Let me make a note to myself. So far we've had 3. And yeah, you can send it in anytime between now and the last class. So
Okay.
we'll also have one for sure for 7 and 8.
Okay.
One from the derivatives section, and that will be enough.
Okay. So those will be the 3 assignments. Then
Yeah,
then I apologize because I wasn't here for the
I
last
know.
class.
Yes.
So this midterm review, are you going to then assign us a midterm, or are we to
Yes.
answer these questions? Are you going to assign
No.
us?
Yes. I have one which I'll be posting, which is not radically different from this one.
Mhm.
So in other words, think of this as the dress rehearsal for the real thing. So
And that will be posted, and when is that one due?
I think 2 weeks from tonight will be fine.
Oh, thank you. All right.
Yeah, I think a couple of weeks, but you can
Okay.
see it's really not that long.
Okay.
So it won't be a problem.
Okay.
Unfortunately, though, with the final, like I said, I do have to have it in by a specific date. So you
Mhm.
won't get quite that much time for it, but I'll try to make
Okay.
sure you have a fairly decent amount of time for it. So yes, anyway, so why don't we run through this real fast? So what exactly, oh, and also I'll be posting these solutions that I'm about to go through with you. So if, let's just say that you missed something,
Mhm.
the answers will be posted anyway.
Okay. Thank you.
Okay. All right. So one key characteristic of a money market security. So there's more than one. I'm going to list 3. So you can pick the one you like the best. They're highly liquid. They have very low risk. In some cases, none, if you're talking about treasury bills. And then they have a very low rate of return. Okay. Any one of those will do. By the way, they published a schedule for the fall.
Mhm.
Oh, have you been registering?
I haven't yet, but I actually reviewed it today with Jean Mann, so
Ah,
I'm going to do
I
that.
always wonder what finance courses they're offering. Do you happen to remember?
No, I
Uh,
don't, but I can forward it to you.
oh, okay. Because you know what?
After.
The funny thing is, they never send that to me.
Well,
It's
I
just,
hadn't received it either. I had to
oh,
ask her for it. So,
okay. It's just more out of curiosity than anything, because the schedule itself tends to change from one year to the next, and I always want to keep my eye on what they're doing. But all right, anyway, so the difference between common and preferred stock. So again, there's a lot of ways you can express this. A common stock represents partial ownership of a corporation, while a preferred stock does not. And that's enough. But you could also mention that a common stock, if you choose to do so, offers investors voting rights, while a preferred stock does not. Okay, you don't have the right to vote at the meetings for the board of directors. Okay, IPO. Now, of course, IPO stands for initial public offering. Is the first time that a corporation issues shares of stock. So in other words, once they've issued it the first time, it's called an IPO. After that, nobody seems to care anymore. It's like it's no longer a big deal. You have to be a corporation to issue stock, but many corporations choose not to do so because that means that the ownership stays within private hands. But when a corporation needs money to expand, the kind of money they need is not likely to be something you can borrow from a bank. So they raise these enormous amounts of money through an IPO, and Wall Street gets all excited, and people are all, it causes a lot of excitement because you can make a lot of money with these if you know what you're doing. After that, it's like, oh, whatever. Another, like Facebook had their IPO, and then now every time they issue shares of stock, it's like whatever. It's just a routine day in Wall Street. Now, an exchange-traded fund is an interesting idea. It's only been around a fairly short period of time. It's like a mutual fund, except that it trades like a stock. But the logic is that you're trying to reproduce an index of some kind, like the entire S&P 500, or maybe just the industrial stocks in the Dow Jones. Whatever it is, there's an exchange-traded fund out there somewhere that you can buy, and that will replicate as closely as possible some index or other. For example, there's a gold ETF. There's one for all kinds of things. The possibilities are almost limitless. But what we need to know is that ETFs trade in the market in the same way that stocks do. In other words, there's an active market for ETFs, and they can be bought or sold at any time during a trading day. Now, another thing that we want to note here, though, is that ETFs are passively managed, which means that once the appropriate stocks are acquired, there's very little change in the composition of the ETF. In other words, you're looking for a set of stocks or possibly other assets that replicate some index or other. Once you've found the right mix, there's no point in changing it. Whereas the opposite of passive is active. So an active fund is one where somebody's trying to buy and sell stocks pretty frequently to take advantage of fluctuations in the market. And it can work. The problem is it's very expensive because, of course, it involves a lot of expenses like fees and commissions. So ETFs are a good way for a small investor to take exposure to a specific segment of the market without having to spend a lot of money. Okay, in other words, if you wanted to buy the entire Standard & Poor's 500, you'd have to spend quite a bit of money, whereas you can shell out, for one of these, the price is something like $250, which almost anyone should be able to afford. All right, what is one of the important differences between a forward and futures contract? Well, once again, there's many differences, but we want to focus on a few of the key ones, and then you can choose the one you want on the test. So forward contracts are negotiated between counterparties, while futures contracts are traded on organized exchanges. Like the CME, for example. I think we talked about that last time. the Chicago Mercantile Exchange, and there's quite a few others scattered throughout the world, but they are specialized derivatives exchanges. That's all they do. Unlike, let's say, the New York Stock Exchange, which only does stocks. All right, another difference is that with a forward contract, there is always some default or credit risk. This is not the case with a futures contract. And that's because the exchange guarantees the contract. The exchange is not going to go out of business. A corporation can go out of business. The exchange is not likely to go out of business. So they can guarantee the performance of these contracts. A futures contract can be offset or unwound by taking the opposite position in the same contract. This is not feasible with a forward contract. All right, so if you're entered into a December British pound futures contract to take delivery of 62,500 pounds, you can get out of that by taking the same contract as the buyer rather than the seller. Okay, and finally, with a forward contract, no cash flows take place until the contract maturity date. A futures contract, though, is marked to market. And this means that the investor must deposit funds into a margin account that acts as collateral against potential losses. And of course, they have to do that because they're guaranteeing the performance of that contract. If you lose a bunch of money, they don't want you sitting there losing more and more money every day. So you can either put up more money or else you're out. They'll close out your position. All right. So call option is the one. This is an option that provides the buyer with the right, but not the obligation to buy an asset in the future at a price that is determined today. The key out of all of that, the key word there is buy. Okay, you're the one who's buying. If you have a put option, you're the one who's selling. All right, now the loanable funds theory. So economic growth increases the demand for loanable funds so that interest rates rise. So in other words, there's no change in the supply necessarily. In fact, suppliers are borrowers in this market. So when the economy heats up, people want to borrow more to buy new goods and services, like houses and cars and all the rest. But also businesses want to invest more. And the fact that there's suddenly this surge in demand for borrowing will, of course, drive up interest rates. Now, with the Fed, expansionary monetary policy, the goal is to expand the size of the economy. So therefore, what they do is they lower interest rates. Okay, so the purpose of expansionary monetary policy is to stimulate consumer spending, business spending, and the best way to do that is to lower interest rates. You know what that reminds me? Remember when we were in that chapter about the Fed and money, we saw the Spanish silver dollars, the pieces of 8 that were cut up into 8 separate pieces. I read something interesting today. They said a lot of those Spanish silver dollars wound up in the United States because pirates would often land in the US and buy their supplies before they went out on their raiding missions. And so a lot of those silver dollars were coming from the pockets of these pirates who had been raiding Spanish ships, who had themselves been stealing the silver from South America and minting it in Panama, it turns out. So that's kind of the trail by which a lot of these Spanish silver dollars wound up in the United States. pirates. I mean, certainly through trade as well, but the U.S. was not on very good terms with Spain, since, you know, they were the enemies of England. So, but the pirates, they were very busy in that area up until the early 1700s, when they sort of, I guess the governments of those countries in that area finally got together and said, you know what, they're causing us more trouble than they're worth. Let's get rid of them. But they had a good time for about 50 years, that's for sure. So anyway, so with the Fisher effect, this is the Fisher effect, the nominal rate of interest. Well, I'll write it out in English first. Equals expected inflation plus the real rate. So now what they're asking us to do is solve for the real rate. So algebraically, the real rate must be the nominal rate minus expected inflation. Okay, and so therefore, in this case, that would be 3% minus 2% equals 1%. Okay, that would be the inflation adjusted rate. This is the increase in your purchasing power that you get by earning the 3% in your, let's say, your bank account. Anyway, based on the Standard & Poor's rating scale, what's the lowest rated bond that's considered to be investment grade? So if you remember the way that scale works, it starts at AAA, goes down to the AA plus, et cetera, et cetera. The bottom of the barrel within the investment grade group is BBB minus. Once it gets below that level, it becomes junk bonds. And that's because historically, the probability of default jumps up quite a bit when we get past that point. There's something about that hurdle line there. Any bond that's rated less than that, there's a significant increase in the credit default rate. Now, the U.S. Treasury curve traditionally has been upward sloping. It can have many different shapes and still be upward sloping, but normally the long end of the curve is higher than the short end. Not always, there are exceptions, but the bulk of the time, it's facing up. Okay. Now, why is this? Why are the long maturity bonds? Now, the logic here is that the longer maturity bonds are riskier. It's not credit risk, though, that they're different. What happens here is that the long maturity bonds have more cash flows than short maturity bonds. And many of these cash flows take place further into the future. Therefore, the impact of a change in interest rates will be greater on the long maturity bonds than the short maturity bonds. Okay, and so for that reason, prices of long maturity bonds fluctuate more than for short maturity bonds and are therefore considered to be riskier because the prices change more. The impact is greater for a bond that's like 30 years versus 5 years. There's a lot more cash flows with the 30-year bond, and many of them take place way out in the future. And so their present values are affected more by interest rates than the short maturity bonds. All right, then we're looking at these different theories of the term structure of interest rates. So in the pure expectations theory, we're assuming that everybody's happy with any maturity of the bonds, no matter what your own personal investment horizon is. Let's say you really want to invest for 10 years, then you'd be okay with buying a 5-year bond and rolling it over for 5 years, or a 10-year bond, or a 20-year bond and selling it after 10 years. It doesn't matter to you as long as 10 years are involved. Now, in reality, that's probably not a great assumption. So instead, with the liquidity premium theory, we are being given extra compensation for holding long maturity bonds, which are, of course, as we've already seen, a little bit riskier. Okay, the functions of money, the money chapter. We love the money chapter. Store of value. Well, first, medium of exchange, store of value, unit of account. And of course, nobody will ever forget this as long as they live. What Pacific island uses huge stone wheels as a form of money? That's right. It's our old friend Yap. All right. I don't know if they have any direct flights yet between New York and Yap, but if they do, we might want to go down there and check this out. It's very interesting. All right. It's somewhere, it's not that far from Australia, apparently. So the Fed was created in 1913. The monetary base equals total reserves plus currency in circulation. And the significance of that is that this is what the Fed actually controls. They don't directly control the money supply, but they do control the monetary base, where there's a connection between the two, although that connection is not completely under the control of the Fed. It depends on how much banks are willing to lend out, and it depends on how much currency people are willing to hold, which, of course, in these days is not much. But that's why banks don't have a lot of cash laying around. And that's why the largest note that we have now is $100. It's not much when you think about it, $100. But then on the other hand, cash, what is that? In fact, it got worse during the COVID. Remember, there were times when these stores would tell you, don't give them coins and notes. They just want credit cards. Well, whatever the problem was. I remember the McDonald's in my local mall. They didn't actually say we won't take cash, but they were pushing hard to avoid it. Okay. Now, which component of the Fed regulates the banking system? That would be the Board of Governors in Washington. Which committee conducts monetary policy? That is our friend, the Federal Open Market Committee. They get together 8 times a year and they decide what to do about interest rates. So the world pays a lot of attention to them. It's not just the US. When they get together, everyone wants to know what they're doing. In fact, I don't know if I ever told you this funny, amusing, interesting thing about the Fed. In the 80s and 90s, the chairman of the Fed was Alan Greenspan, who was on the news all the time. There's just something about him that fascinated people. I think he ended up having the longest term as Fed chairman anyway. And so one of the things that would happen is he lived apparently not too far from the office. So he walked to work in Washington, I mean. And so he carried a briefcase with him every day. And so what would happen is on the day of the FOMC meeting, the reporters would follow him around with cameras and they would look at his briefcase. They had a theory, and I don't remember how it worked, but the thickness of the briefcase was supposed to tell us whether they were going to raise rates or not. Now, I don't remember what way it was supposed to go, like was if thick meant raising rates and thin meant not, or vice versa, but people took it just seriously enough that the cameras would follow this guy around and watch to see how thick his briefcase was. So they could report back to Wall Street, ooh, look how thick his briefcase is today. Now, for all we know, he may have had his lunch in there. We don't know. But that was the theory that prevailed at the time. It was kind of interesting. And there were people on Wall Street who were called Fed watchers. Their only job was to keep an eye on the wily old Fed and try to figure out what they were going to do. Not so much anymore. I guess they realized that they were wasting their time for the most part. All right. Well, anyway, enough fun Fed stories. Although I remember that there was an article in one of the big news magazines, and they said that except for the fact that he doesn't control any armies. Greenspan is basically the most powerful man in the world. And to a large degree, that was true. All right, so open market operations are the most popular, widely used tool of monetary policy. This is something they may potentially do every single day. And it involves buying and selling bonds from the banking system. Through the traders, the Fed has its own traders in the New York Fed, and they do get on the phone just about every day, and they make transactions with the financial community. So the discount rate is the rate at which the Fed lends money to banks. Now, it used to be very restrictive. They would only lend out money for really serious crises. I mean, like, whoa, we had a tornado in our district. We need money. Now it's apparently a lot easier to get money from them because they want to make sure that the banks don't run into problems. So it's a little bit easier, but it's still more costly than it would be to go into the Fed funds market and borrow from that, other banks. So the required reserve ratio, this is the proportion of deposits that must be held with the Fed in the form of reserves, or else held in the form of vault cash, they call it. So the cash that the bank actually hangs on to, which is not very much anymore, counts as reserves because it has not yet been lent out to the public. All right, now commercial paper. This is a short-term debt security issued by corporations to raise funds, obviously short-term funds. And they only go out 270 days. It has something to do with the law. After that, the category changes and there's more regulation and all this and that. So they, just to keep it simple, to avoid a lot of problems, they just keep the maturity under 270 days. What happened here? Okay, and finally, the federal funds rate. This is the rate that banks charge each other for short-term loans of reserves. So if they're short of their targets, they go into the Fed funds market and they borrow it from each other. It's very easy. It's a big liquid market, and the interest is very low. It's probably quicker and easier than borrowing it from a bank. And it's also less of a headache than borrowing it directly from the Fed because, let's face it, it's like, I don't know, it calls attention to your activities. The Fed may say to you, well, you can have the money, but how come you're constantly running out of reserves? So it doesn't invite scrutiny when you go to the other banks. All right, now, the loanable funds framework. You might recall that here what we've got is a set of graphs. And so, for example, whoops. What do we have? We have the rate and the quantity of loanable funds. So we have a supply curve, which in the book they use SAA for aggregate, because they're basically telling you that the supply of funds comes from many different sources. Aggregate means total. Same thing with demand, although in some examples they break them up into component parts. Here's your equilibrium. I'll call that R1 and Q1. If the foreign demand for loanable funds goes up, or if any component of the demand for loanable funds goes up, of course the entire curve shifts to the right. We move from point 1 to 2. And guess what happens? Interest rates go up, as does the quantity of loanable funds in the market. So they just want to know about the equilibrium rate of interest. So the answer here is that the interest rate goes up. Okay, which makes sense. Like I said before, anytime anything causes there to be an increase in demand for loanable funds, the interest rates have to go up because there's only so many available. All right. For B, now this one is kind of interesting. The rate of inflation. The rate of inflation affects both the supply and demand for loanable funds. So it's a little bit more challenging. So it turns out that the demand goes up, but the supply goes down. And that's because when you're a borrower, you actually benefit from inflation because in real terms, the amount that you're paying back is actually shrinking. So borrowers benefit from inflation, but guess who does not? Lenders. They get burned because their returns are shrinking in real terms. So let's say that this is 1, 2, and 3. Now, the quantity could actually go down or up slightly depending on where these curves go. But no matter what happens, the interest rate goes up, which completely makes sense. If you look at the Fisher effect, you'll see that. Let's go back and find the Fisher effect. Basically, what's happening here is that these actions are driving up. I mean, inflation is going up. If inflation is going up with no change to the real rate, then the nominal rate has to go up as well. So it shouldn't be no surprise that inflation causes rates to go up. And then finally, in the last case, we have an increase in the federal deficit. Now, this one is also fairly commonsensical. Anytime there's an increase in borrowing, well, you know what interest rates have to do? They have to go up because there's no increase in the supply. Okay, so again, with part C, the deficit goes up. What's new about that? I'm telling you. So the demand curve can go to the right. It doesn't have to go up by a ton. I mean, as long as it goes up. We'll see, we should see a higher interest rate. Okay, so in this case, rates go up because the government is increasing its deficit. Of course it is. All right. Now, these last few questions are basically algebra. So the pure expectations theory, what we're going to do here is take these are 1-year rates, okay? So what we're going to do, because we're only interested in the 3-year rate, we're going to take the 3 of them and because this is a 3-year rate of interest, we're solving for X, the 3-year rate of interest. So the rest is just algebra. What I'm going to do is raise both sides to the 1/3 power. Just a quick reminder over here. by raising both sides of the 1/3 power, you're essentially eliminating this exponent. Okay, so that means what I'm doing now to make, because I have to solve for 1 plus x. So what do? Well, let's do this. If I raise both sides of the 1/3 power, on the right-hand side, I just have 1 plus x. Now, if you multiply those out, it's approximately 1.09 to 624. I'm raising that to the 1/3 power. Or you might be more familiar with it as known as the cube root of x. Okay. That sounds so cool, doesn't it? The cube root of x. When's the last time you ran into that at work? The cube root of anything. Not recently, I bet. Too bad. We should have more math in our lives. They're like intellectual vitamins, I think. Okay. So it's just a hair under 3%. Yes. Imagine that. Instead of getting up every day and going to the gym, you go to the math lab. Okay, why not? That part of your body needs work too, doesn't it? All right, now for the liquidity premium, here's what we're doing differently. We're adding these premiums to these numbers. So it's essentially the same problem, except we're adding the liquidity premium. So the 1 year is 0, but the rate 1 year from now is 0.2. And for the next one, it's 0.3. So that's what you're doing here. You're adding that premium to the existing rates. And then you're just doing the rest is the same. It's just the algebra. 1.02, 1.032. And of course, it'll end up being higher. And that's the whole point of this, that with the liquidity premium theory, long-term rates should be higher than they would be without, with the expectations theory. So that on the left-hand side, oh, look what I did. This doesn't belong here just yet. All right, now I'm going to copy it down. Oh, 1/3. This is just plain 1 plus x. So in the parentheses, we have 1.0979 raised to the 1/3 power. Minus 1 equals x. And so the final result is approximately 0.3162 is x. And it is higher than we thought, or at least it's higher than what it was with the pure expectations theory. All right, well, that was the whole thing. You can see it's not that painful. Okay. So I'll be posting this on the Blackboard. You can double check these. And now we can jump back. We're partially done with chapter 10. Not completely though. And then 11. 11 is a little bit more involved. 10 is more qualitative. There we go. So stock quotes. I think we mentioned the stock quote, and then we can move on from there. Just a quick reminder, with a stock quote, obviously high means the highest value reached during the last 52 weeks, low is the lowest. The dividend is $1 per share every quarter. That means that the yield is 2%. P ratio, PE is price earnings, which means the ratio of the price of the stock to the earnings per share or income per share. The trading volume is 9,000. The closing price that day was $50, and that's up 27 cents from the previous day. All right, let's see. Now, just a quick overview of buying and selling stocks. Now, a lot of us only buy and sell stocks through our 401k plans. But if you've got plenty of money to invest and you're tired of getting so little interest in the bank, you can get an online broker, and then you can buy and sell. And some of them are very expensive, but they provide you with a lot of services. Others are essentially free. But if you need advice, you're on your own. So you just have to find what works for you. And so you find a broker that makes sense for you. And so again, what separates them is how much they charge and what kind of services you get. The full service ones are expensive, but they can give you everything you could possibly want. They'll give you investment advice. They'll give you research reports, anything you could possibly imagine, they have it. Whereas the discount brokers are really more for the smaller investor who doesn't really need all this information, wants to make his or her own decisions, and is not willing to pay such high fees. You see the ads for these guys on TV all the time. Charles Schwab advertises a lot. And there's others you've seen on the internet like Robinhood, which is apparently completely free. It's popular among students, let's put it that way. Let's see. All right, let's jump ahead a little bit here. Order types, just briefly, you may not have known this, but when you buy a share of stock, you can place what's called a market order, which means go out in the market and pay whatever price is necessary to buy or sell the stock. But if you're not willing to pay more than a certain amount, you can place what's called a limit order, which means, yeah, go out and buy the stock, but don't pay more than X dollars for it. The problem with that is that while it could save you money, it also means you might not be able to execute your order. So you have to be aware of that when you place a limit order. It may never get executed. The market order is guaranteed to be executed, but it might end up being very expensive. And there's others too. This is just the tip of the iceberg. There's so many other possible trades you can make. Like here's an example. If you place a limit order to buy Apple stock for $125 a share, it just means that your transaction will sit there until the stock becomes available at $125 or less. And within a certain length of time, if this doesn't happen, your order will simply be canceled. Oh, as I mentioned here, there's online brokers, there's TD Ameritrade, there's E-Trade, and there's Robinhood. Okay. I'm not quite sure why Robinhood chose that name. They're letting you have a very inexpensive platform, but they're not stealing from rich people either, are they? No. That Robinhood, he was sort of like he was a crook, but people didn't mind, I guess. Anyway. Oh, one other thing you got to watch out for, though, is that the more expensive brokers may have a very high minimum investment. It may not be worth their while to do business with you if you've only got $200 to invest. So you might find yourself not being able to meet the minimum requirements if you go to one of the more expensive brokers. Here's another one. Online brokers not only are they inexpensive, but they can put your money that you're not using into a money market account and earn interest. So that while the money sits there, while you're trying to decide what to buy with your money, you can earn some interest, which is very, very helpful. All right. On margin, now you may have heard about this. You can actually buy, if you're in a good position financially, you can buy margin on stock, a stock on margin rather, which means you're basically borrowing the money that you're using to buy the stock. Now that means that your returns could be much higher, but you could also really do very poorly if the stock price goes down. So it's basically a way of magnifying your risk, which could also magnify your return, but it's also potentially going to put you into a rough spot if something goes wrong here. In other words, you could end up losing more than you started out with. And that's always a dangerous position to be in. Now, short selling is something that's very difficult to arrange, but it can be done. It means that you have the ability to borrow shares of stock that you don't own and then sell them and then buy them back later on, hopefully at a lower price. So anyway, so there was a case with Cornelius Vanderbilt in the early 20th century where, Vanderbilt was very powerful, very rich. He built the railroads that come into New York City. And his rivals, let's say we shall call them, were very jealous of him, and they were always trying to do something to sabotage his success. So what happened was, apparently Vanderbilt had applied for permission to build another railroad coming into Manhattan. And the decision was up to City Hall, the mayor, will we allow this or not? So these guys, these other rivals got together and said, here's what we'll do. We have friends inside City Hall. We have it on good authority that the mayor is going to turn this one down. And if he does, the price of Vanderbilt stock will fall pretty significantly. So they all got together and they short sold the stock, being very confident that they could buy it back and make a lot of money. So Vanderbilt is on vacation in Europe at this time, and he gets wind of this plot. And he sends them this very cryptic telegram, and it says, "Gentlemen, you have undertaken to swindle me. I will ruin you. Signed, Cornelius Vanderbilt." Now, I don't know about you, but if I got a telegram like that from Cornelius Vanderbilt, I would be very uncomfortable. Okay, one of the most powerful men in the world has told me he's going to ruin me. So you know how he did it? He went out and he bought up all the outstanding shares of his own stock, so that when these guys were required to replace the stocks they had borrowed, they could only get it from him. And that meant he could charge them any price he wanted. And he did, in fact, ruin them all financially. So let's just say that it turned out not to be a smart move. Okay, it would be like me calling up Jeff Bezos and saying, "Jeff, baby, I'm going to take advantage of you somehow." No, you don't do things like that. All right. Well, anyway. So you short sell, and normally what's supposed to happen is you buy them back at a lower price and you make a profit. But this is a very complicated thing to set up. It requires a lot of fees, and it's difficult to do it, but it can be done. All right, now analyzing stocks. How do you know which ones to buy and sell? Well, for the most part, you're looking at the corporation's financial statements. Now, this is something that would require an entire class to go over. Now, I don't just mean one class, like an entire course could be dedicated to doing this properly. But in general, there's certain things we look for when analyzing stocks. So remember, the whole point is to find out which stocks you think are going to go up in value. Why would they do that? Because they have exciting new products coming out, because they've found a way to lower their cost of production. There's all kinds of reasons why a company might do well. So what we need to do is try to figure out how to figure this out ourselves. Now, two ways of going about this are fundamental analysis and technical analysis. And you may have heard of these. Fundamental analysis means you're looking at economic variables to determine how valuable the company is, like revenues and costs and profits, and use that information to figure out what the stock should be selling for. And then you can decide if it's over or underpriced. This is how Warren Buffett makes his money. He knows these financial statements like the back of his hand. And when he sees something interesting, he buys it or he sells it. So like a fundamental analyst who's looking at Apple would say, well, we want to analyze what new products they're bringing out. What kind of profits are they bringing in? Where are they likely to be able to sell these? That kind of thing. But they'd also look at the big picture. Is the economy doing well? International competition, that type of thing. Now, the technical analysts are, interestingly enough, they're only looking at one thing, and that's the price of the stock itself. They're trying to use the past history of that stock to figure out where it's going in the future. And sometimes it works and sometimes it doesn't. In fact, they have their own system of looking at these charts. Let me just see if I can find a picture of this. Oh, those are books. No. I wanted a picture of. I know. The only one I remember the name of is the candlestick chart. Look what they put in there. So what they would do is they would look at the pattern of these candlesticks and say, what's going on with this stock? And they have all these different strategies, and they look at these candlesticks and say, oh, okay, well, look at this. It's gone up every day for the last 3 days in a row. Therefore, it must continue, right? So there's all kinds of rules and strategies that they've developed, but in none of these cases do they look at the fundamental value of the company. They're just looking at its past price history and assuming that that will continue into the future. So you might say, well, what a foolish idea this is. But I've been told by people who know more about this than I do that this can actually work very well within very short time frames, like within a matter of hours or maybe a day or two. It can work, but only for short periods of time. And that's a lot of studying you have to do to learn these patterns. Whereas the fundamentals, this is more big picture, long-term stuff. So there's two basic financial statements that you might be asked to look at if you were some kind of financial analyst: the balance sheet and the income statement, which you may have seen in other classes, by the way. The balance sheet shows the corporation's assets, the liabilities, and their equity. The assets are what they own: cash, inventories, buildings, equipment, etc. The liabilities are what they owe, like all the bonds they've issued, the accounts payable, which, by the way, if you have no accounting background at all, accounts payable means this is money that we owe to somebody else that is due within a short period of time. Like, imagine a corporation has just bought a bunch of paper from Dunder Mifflin. All right, why would we go with them? We don't know, but let's say we do. Michael Scott squeezed our arms and we bought paper from him, but we haven't paid for it yet. That goes into the category of accounts payable because we expect to pay it very soon. And then deferred taxes, these are taxes that are owed but haven't been collected yet because they're not due just yet. Like sales taxes. If the corporation collects sales taxes, I think they only have to pay them like once every quarter. And so while we might owe taxes during the next quarter, we haven't actually paid them yet. These are liabilities. All right. Now, equity is the difference between assets and liabilities. This is what the corporation is worth to the owners. It's like with a house. When you buy a house, you get a mortgage, and over time, you pay off the balance of the mortgage, and the amount that you own, the equity, will grow because the asset, the house, is growing in value. The liability, the amount you still owe the bank, is shrinking. So the equity in your house is growing. Now, here's a financial. Now, I know it's very small, hard to read, but this is a typical balance sheet. And you can see on the left-hand side, we have the assets, which are broken down into current or short-term assets. Down here, we have the long-term assets, and down here, the grand total. On the right-hand side, we have the liabilities broken down into current or short-term and long-term. We add them up, and the difference between the assets and the liabilities is here shareholders' equity, which is worth $22.20 million. So the amount we own is worth $22.20 million more than what we owe. The income statement shows the flows of revenues into the company and the flows of expenses out of the company. So some of the key details are the sales or revenues. The cost of goods sold is an important detail. depreciation, which we'll discuss in a second, and of course, taxes. So corporations sell products to the public. The revenues are their where they're getting this money from is sales, and cost of goods sold are the cost of the producing the product that you're selling. In economics, these would be known as variable costs. For example, Starbucks, their cost of goods sold include things like coffee beans, milk, sugar, cinnamon, syrups, cups. These are all things that are used to produce their products. What's not there is things like manager salaries and electricity bills and things like that. Those would be considered fixed costs because they do not change with the output of coffee. Depreciation refers to the loss of value of equipment due to use over time. Like your car has depreciation every year. It's not as valuable as it was last year because you've driven it all this time. So, but luckily for the corporation, this is tax deductible. So this is why it's listed separately. It's an important detail. And then finally, when we subtract all of our expenses, including taxes, what's left over is net income or earnings. That's the number that we're all focused on as investors. That's what's going to tell us how valuable this company is, because when you buy the company, what you're really buying is a stream of net incomes in the foreseeable future. It's kind of like if you bought a business. Let's say your neighbor owns a McDonald's franchise and you buy it from your neighbor. What are you actually paying for? You're paying for the revenue streams that they're generating at the store. Okay. But anyway, net income is doled out in two different ways. We have dividends that are paid to the shareholders, but the rest, the part that we don't distribute, is called retained earnings. That's the money we reinvest in the operations of the company to hopefully grow more quickly in the future. A dividend is a cash payment made by the corporation to the shareholders, but it's optional. It's not required. Unlike coupon bonds, where you must pay that interest. And retained earnings are often saved to cover expenses, although they often use them for development of new products and that type of thing. And so, now here's an example. Now, here's how this XYZ Corporation's net income was calculated. The sales or revenues are, this is what comes in. The cost of goods sold, 153.40, is subtracted, leaving us with a gross profit of $33.3 million. Now, here we subtract the fixed costs, the ones that do not change with the output of our product. Selling, general, administrative. It's kind of a catch-all for things like salaries and taxes on the building and rent and all this and that. Then there's research and development, depreciation. When all that's subtracted, we have what's called operating income, to which we add any other unusual income to come up with this concept: earnings before interest and taxes, often known as EBIT. Then we subtract the interest expense on our bonds because that's tax deductible. And now we have earnings before taxes. We subtract the taxes, and what's left is our net income. So it's not that complicated, but most financial statements are a lot more involved because they have a lot more categories than what you're seeing here. But the basic logic is the same. Okay. Now, the impact of performance on the stock's price. Well, clearly, the better the corporation performs, the more profitable it is, the more people want to buy that stock, and the stronger the price will be. So, in fact, we have this wonderful little diagram which shows you that in the top, the company has strong sales, strong profits. Investors are confident. So, therefore, they want to buy more shares of the stock. But the people who own it already are less likely to sell it. And that drives up the price of the stock. So it's just straight ahead supply and demand here. On the other hand, if the company has a rough year, people start to become pessimistic. Then the people who want to buy the stock shrinks. The people who want to sell it will go up. And lo and behold, the price of the stock goes down. So in a nutshell, this is what's driving the prices of our stocks. A lot of it just comes down to confidence. All right, but this confidence is based on past performance. And then finally, we do have to pay attention to the overall economy when we focus on stock prices. We have to pay attention to economic growth, international economic conditions, interest rates, and inflation. Now, growth refers to the growth of the overall economy, meaning gross domestic product. That's the value of all the goods and services that we produce every year. We want this to grow as fast as possible because that raises our standards of living. If the economy is growing strongly, the stock market should be doing very well because all the corporations are basically benefiting from this. International conditions. Now, there's all kinds of things that could be going on here. The strength of the dollar, for example, the price of imports like oil, political turmoil, you name it. International economic conditions can have a major impact on the US stock market. The better things appear to be going in the world, the stronger the stock market will be, of course. Interest rates. Now, for the most part, higher interest rates are detrimental to corporate profits because it means you have to pay more to borrow. So that being the case, often interest rates going up reduces profits from corporations. And so that's, but not all of them. I mean, like for example, with banks, it might be the other way around. But you have to take that into account when you analyze a business. Inflation is very harmful to businesses because it reduces the purchasing power of the dollar, which in turn means that your goods are becoming more expensive in real terms. Inflation doesn't really help anyone except borrowers. And even then, there's no guarantee that they'll benefit from it directly because their own expenses might go up. And then finally, industry conditions. We always have to take into account what industry a company is working in. We know, for example, General Motors is part of the auto industry, which is obviously not in the best of shape. And so economic conditions can help some industries and hurt others. Technology, it can make things obsolete, of course. So, for example, now, by the way, that reminds me, there's still a single blockbuster video in the country somewhere, one. It's still out there somewhere, and it's still, people are still going there. But obviously they disappeared because of technology. Or how about tobacco? I mean, really, if you were in the tobacco industry, you'd be pretty unhappy right about now because people aren't smoking as much as they used to. And oh, here we go. So here's the factors that we were just discussing. On the top, we have the good factors like strong growth, low interest rates, etc. Again, you notice how it drives expectations, which in turn determines whether or not we want to buy the stock or if we want to sell it. So because if our expectations go up for the performance of the firm, we'll buy more shares, people will sell less shares, the price has to go up. Down here, when the economy isn't doing so well, we expect poor performance from our corporation. People are less likely to buy the stock, they're more likely to sell it, and the price drops. All right, so this is all big picture stuff. Now we want to develop some actual models, mathematical models, that help us understand how to price a stock. Now, there's many ways of pricing a stock. What we're about to see is not the only way to price stocks. In fact, these are some of the simpler ways of going about this. But they're a good starting point. Whoops. Let's get chapter 10 out of the way here, and then we'll start 11. This is the one we're looking at actual, this will be much more quantitative. So we're going to be looking at stock valuation and risk. So there's a lot going on in this chapter. So we're going to be looking at pricing models, and measurement of risk of owning stocks. So there are many methods for pricing stocks. Some of them are very sophisticated, like Warren Buffett. I'm sure the approach he uses is very sophisticated, but ultimately all he's doing is looking at the information contained on the corporation's financial statements. Others are based exclusively on dividend payments. Some of them look at corporate financial ratios from the corporation's income and financial balance sheet, income statement and balance sheet. And so there's a lot of ways of doing this. Do they work? Well, that's a good question. Now, overall stocks, as you'll see, are much more difficult to price than bonds for several reasons. Number one, the cash flows are much more difficult to estimate. Stocks do not have a fixed set of cash flows, unlike bonds, where the coupon payments and the principal repayment are locked into a contract between the owner and the buyer. Number two, unlike bonds that have a finite lifetime, stocks do not. They last as long as the corporation does. So a Coca-Cola share that was issued in the 1890s is still valid. So those stocks have what we will call an infinite lifetime. And since the value of the stock is ultimately based on present value concepts, we're going to note that the discount rate for a stock is much more challenging to calculate than it would be for a bond. So it looks like we're in a lot of trouble here. Well, what can you do? So we try. So we'll be looking at three basic methods for pricing stocks. One is called the price earnings method, one is called the dividend discount model, and one is called the capital asset pricing model, or CAPM. All right, price earnings method. This involves the PE ratio, by the way. We're looking at the PE ratio, which is the price relative to the net income per share. And a higher PE means either we expect the profits to grow in the future, or else it could mean that the stock is overpriced, that the market is overvaluing the stock. So now, at this point in time, PE ratios are quite high in general. Some of them are absurdly high. But let's say a company like ExxonMobil. Let's see what kind of PE ratio they have. It's right here. Oh, NA. You know why? Because they had negative earnings last quarter. I don't know how an oil company loses money, but they managed to do it. All right, let's try instead General Motors. So the P ratio is 9.48 to 1. So when I buy a share of this stock, the price that I'm paying is 9.48 times the earnings per share of that corporation. Is that a lot? Well, that kind of number only can be judged by comparison with other companies in the same industry. That might be very high for the auto industry and very low for retail, for example, or it could be the other way around. I don't really know off the top of my head. We could probably find out. Maybe. Let's see. So the average for the entire S&P 500 has historically ranged from 13 to 15. The high multiple, for example, a company with a PE of 25 is trading at 25 times earnings, which means we expect higher growth compared to the overall market. So even though that means the stock is expensive, that's actually a vote of confidence in that stock. So in a way, it's a good thing that these PE ratios are as high as they are. They do tend to fluctuate with the economy, though. They tend to fall during a recession and rise during a recovery. So, oh, maybe we can get it from here. This is January, so let's say, so look at these numbers. Let's try precious metals, 19.65. Steel, 76.29. Oh my God. Trucking, etc. So they're all here. Wow. But anyway, so what we're going to do here, now this method is usually based on the assumption that we don't have a whole lot of other information. This is kind of like a rough first approximation, but if you take the expected earnings per share and multiply it by the overall average PE ratio for that industry, you can come up with a rough value for your stock price. But you usually don't use this. This is not your first choice. Let's put it that way. You can think of this as your last resort because it requires very little actual information. So let's say that an oil stock is expected to earn $5 per share over the coming year. And that could be based on a forecast of their past recent history. The average ratio in this industry, let's say it's 15, which means we project the stock price to be $75 a share. You can see it's very crude and primitive, but a lot of people use it, at least to get a first idea of what the stock is worth. Very well. Now, of course, we're assuming a lot here that the growth of our earnings is the same as the other corporations in the same industry. And, but of course, it's not going to work unless we have a good, accurate estimate of the corporation's earnings per share. Now, we're going to move to another approach, which involves dividends. Now, what you're effectively doing here is remember we price bonds by discounting their coupon payments. We're doing something similar here. We're actually discounting the corporation's dividend payments to come up with a present value which represents the stock's price. Now, you might say, well, that sounds like a good idea. The problem is, like I said before, unlike a bond where you must provide the coupon payments that you've promised, that's not happening here. And so because of that, this model doesn't work very well unless we find a corporation that does regularly pay dividends. And there really aren't that many of them that are very consistent with their payment of dividends. Okay, so how does this work? And by the way, of course, you recall that with the stock, the reason why you buy it is because you might get capital gains and you also might get dividend payments. It's not like a bond where you're locking in a specific set of cash flows. So a capital gain results when an asset is sold at a price that is greater than the purchase price. A capital loss is just the opposite. That's what you're mainly making your money from, not so much the dividends, if there are any, but a capital gain. Now, of course, the dividend payments can change. That's another awkward feature of stocks. Bonds, the coupons never change. Because when you buy a bond, you're entering into a contract with the borrower rather, and they cannot change. And here's one more interesting difference. A bond has a fixed maturity date. The stock does not. The stock lasts forever unless the corporation goes bankrupt. So for all these reasons, it's much trickier to price stocks than bonds. But ultimately, you can make the case that the price of a stock, like the price of a bond, is the present value of all the future cash flows to that security. And here we're assuming that that would be the present value of these dividends. So here we go. Here's an example. Now, if you notice, P0 is this current price. The subscripts represent time, by the way. D1 is next year's dividend. D2 is the year after's dividend. And so the subscript represents the time when we receive that dividend. The 0 over here means that this is the current price of the stock, and R is the appropriate interest rate for that stock. So the R reflects the risk of the stock. Now, there's multiple ways of actually estimating R, which we'll not address right now. But this is another area of concern with stock pricing models. With bonds, yields are easy to estimate. With stocks, this rate of interest is very difficult because every stock is unique. That R reflects all the features that are common to all stocks, but also the features that are common to that, or they're unique about that stock. So the R is a very difficult thing to estimate properly. So there's a lot going on here that's very difficult to deal with. And if you notice down here, these dividends literally go out to infinity because there's no finite date or lifetime for this stock. It goes on forever. So there's a lot of issues here that we have to deal with, all of which makes our job more complicated in pricing stocks, as opposed to bonds, which are much, much simpler. Much simpler. All right. Oh, and by the way, the interest rate, it doesn't just reflect the risk of the stock. This, you can think of this as the minimum return at which investors will buy the stock. If not, if it's lower than that, let's say it says it's 12%, that means if investors can't realistically expect to get at least a 12% return from the stock, they're not going to buy it. Why would they? So that R sometimes is called a discount rate. It's also called a hurdle rate. And later we'll see it's also called the cost of equity. It has all these different names that mean the same thing. Okay, so we're going to start with a single period just to get some numerical examples in here. If the stock is expected to be held for a single period, meaning a year, we can use the following model to figure out the price at which an investor might be willing to buy it. So first things first, how do you calculate the return to a stock? Okay, well, what do we have going on here? P1 minus P0 is the capital gain or loss. Now, D1 is the dividend. So up here in the numerator, we have the cash flow received from the stock. That would be the dollar return to the stock. But we're really interested in the rate of return. So in other words, we have to divide now by P0 to convert this into percentage. We can think of this as the percentage rate of return to the stockholder. And D can be 0, and this still works. Now, if I take this and algebraically rearrange it, this is what I end up with. So you can think of this as the present value of next year's cash flows. And by that, I mean the dividend plus the sell price of the stock. Okay. So here's a quick example. A share of XYZ stock is selling for $50. The dividend is $2 a year, and we expect to be able to sell it for $55 in 1 year. What kind of rate of return is that? Well, now imagine yourself as an investor, and you believe that the appropriate discount rate for this stock is 8%. So next year, you expect to get a cash flow of $2 for the dividend and $55 for the stock price. We'll discount those by 8%, 1.808%. These exponents are actually ones because we're selling the stock next year. So this investor considers the stock to be worth $52.78. If the market price is 50, that means this investor considers the stock to be a bargain and will happily pay $50 for it. So because we think the appropriate interest rate is 8%, we consider this to be a good buy, and we might just go ahead and buy it. As far as we're concerned, it's undervalued in the market. But here's another investor who's very worried about the risk of the stock. And as far as they're concerned, the minimum that they're willing to return from the stock is 16%. So from their perspective, the stock is really only worth $49.14. And so if the actual price is 50, then this investor considers it to be overvalued and they will sell it. All right. So now the two of them can get together in the market, and this first person will say, oh, I see you have a share of that stock for sale. I would like to buy it. I'll give you $50. And the other one says, sure, I'll take it. So the transaction takes place because of a difference of opinion about what the stock is really worth. Okay, without a difference of opinion, there'd be no markets. All right. So what's coming up next is we're going to look at what happens with a 2-period model where we're planning on holding the stock for 2 years, gathering all the cash flows and figuring out what it's worth. So, but since it's 8:30, I think we can stop for a few minutes and have our break. And when we get back, we'll dive more deeply into this. All right. Let me just quickly save this. All right. All right, let's carry on with this. So what about the 2-period model? So the first one on top you've already seen. Now you can see that here in the second case, we just changed the time steps. So in other words, in P0, that's the price today. We're looking 1 period ahead to next period's dividend and next period's price. So that means that in period 1, which is a year from today, it makes sense that we'd be looking ahead to the dividend in year 2, as well as the price in year 2. But algebraically, here's where it gets interesting. P1 is part of this first expression. So what I'm going to do is substitute all of this up here to come up with a new 2-period model. All right, and you'll see it's not that different than what we just have done. And so this is the bottom line right here. So what you're saying here is that I'm preparing to sell the stock in 2 periods, or in this case, 2 years. Along the way, I'll collect 2 dividends. So the price of the stock is really nothing but the present value of the remaining cash flows. And since I'm planning on selling the stock in 2 years, these are all the cash flows that I should get. So I'll collect a dividend in year 1, I'll collect a dividend in year 2, and then I'll sell the stock for price P2. And you notice how the exponents now match up with the time in which the cash flows are received. Here, there's an implicit 1 here. So that represents year 1, and then these other 2 take place in year 2. Now, as you can probably imagine, based on that logic, I could now extend this into a 3-year model or 3-period model. I could do a 4-year model and a 5 and a 6, as many as I want. And so we're going to generalize this to H periods, where H stands for horizon. And so I've got a string of dividends. And at some point in the future, H periods in the future, I will sell the stock for price PH. So ultimately, what I'm doing here is simply, again, pricing all these future dividends and future stock price to come up with a number. Now, the reason why this is all necessary, of course, is because this original model has an infinite number of dividends. And obviously, we can't have a model with an infinite number of dividends. But algebraically, it turns out this expression and the one we just saw are actually the same thing. Because the price, whenever we sell it, stock, the price reflects all the future dividends. So this price incorporates all the future dividends, which would be DH plus 1, DH plus 2, all the way out to D infinity. So any way you slice it, the model is still telling us that the value of the stock equals the present value of an infinite stream of dividends, but we can change the distribution of those dividends by using a price that at which we hope to sell the stock, which itself incorporates all the cash flows from that point on all the way out to infinity. Now, with that as our starting point, what we're going to do is look at some special cases. We're going to make some assumptions about the dividends. So here's some cases that we often run into in finance. The case where the dividends do not grow at all, where there is a growth rate, but it's constant. And then the most complicated and challenging case is the one where there is a non-constant dividend growth rate. So we'll see as we go along how this works. The first 2 are pretty straightforward because, as it turns out, this formula, in spite of its infinite number of cash flows, reduces very simply when we have either 0 growth or constant growth. It's the third one that we have to keep an eye on. All right, so with 0 growth, that means all the dividends are equal to each other. They never change. So that means that when you plug in these numbers, they're all just plain D now. Before we had a subscript because these could be different from each other. Now, when that's not true, we have a cash flow of D every year going all the way out to infinity. And now all of a sudden, what we have in our hands is a perpetuity, which if you recall, a perpetuity is a security that makes a annual or regular stream of cash flows that never change forever. Okay, so for example, it's a security that makes cash flows forever but never repays the original principal. A bond that has these features is referred to in finance as a consul. And I think I may have already mentioned that the British government sold some of these during their Napoleonic Wars because they weren't sure if they could afford to repay the principal. So they said, well, here's what we'll do. The people are feeling very patriotic right about now. If we offer them these bonds where you basically are getting a lifetime of interest payments and no principal, they'll buy them, and then we'll be able to finance the war very cheaply, whereas otherwise we would have had a problem on our hands. So as we know that this must have worked because, of course, Napoleon never was able to invade England, and we're all speaking English right now. So clearly the strategy worked. So, but then later on, the British government bought them all back, so they don't exist any longer. But if they were out there, then the heirs of these people who bought the bonds would still be collecting the interest payments. Now, as it turns out, the pricing formula for a perpetuity is very simple. All you have to do is take the annual cash flow and divide by the appropriate rate of interest, where, of course, R reflects, as usual, the risk of the security. So it's just D over R. It's that simple. But in this case, it's a stock. It's a stock with a fixed dividend. And it turns out that we can often price preferred shares of stock by treating them as perpetuities because preferred shares, the dividend is more predictable and it often does not change. So therefore, this would be a perfect model for helping us price a preferred stock, not so much a common stock where the dividends are likely to change over time. This is a very appropriate model for pricing preferred stocks. And we often end up doing that. In fact, when corporations try to figure out how much it costs to issue new preferred stock, this is often the model that they end up using. Now, if the perpetuity's cash flows grow at a fixed rate over time, let's say they go up 2% every year or 3%, then the model can be adjusted very quickly and easily. Okay, so it's just D over R minus G. G is the constant growth rate. And so that's our pricing formula. It's so simple. And so this would refer to you could use it to price a perpetuity where the dividends are assumed to grow at a fixed rate every year forever. Okay, so, and by the way, you have to be very careful with this model. It should be clear, well, I just want to make it clear that whatever period we're in now, the dividend that we're referring to is next year's dividend. Not this year's, but next year's. And D1 itself is equal to the current dividend times 1 plus the growth rate, in case you need that information. Okay, so those two are easy. The next one, it's a bit of a challenge. By the way, algebraically, though, we have to be careful with this one. It must be the case that G is less than R. Otherwise, the model is invalid. Why is that? Well, if R equals G, I'll just mention it up here. Then we have division by 0. So I'm sure you remember from your travels that this is one thing we must never do in math is divide by 0. It's not allowed. And if r is less than g, the denominator is negative, and we'd end up with a negative price. That can't be right. So this model only works well when r is greater than g. So during periods of unusually low interest rates, we often run into trouble here because the market rate of interest might actually be less than the growth rate. All right, now, what do we do about the case where the growth rate is not constant? Oh, by the way, this is an important detail. In general, we can write it like this. No matter what time period t is, as long as the next period's dividend is in the numerator and r minus g is in the denominator, we can apply this to any time period we like. So we could, for example, try to figure out what the price of the stock will be in year 6 or year 8 or whatever it happens to be by using this simple formula. All right, let's look at a quick example of this. A stock currently pays a $2 dividend. That's D0. The growth rate is 3%. And the required return is 7. Well, you know what? Let's figure out the price of the stock. But we have to be careful. Like I said, the numerator is D1, not D0. So we have to figure out D1 first. We have the D0 is 2, the current dividend. The growth rate is 3. So that means next year's dividend is expected to be 206. The growth rate is 7%. The rate of return is 7. The growth rate is 3. That works out to $51.50. According to our model, the price of the stock should be $51.51. All right. Now, by the way, if you take this formula and rearrange it algebraically, you'll get something interesting here. What's happening in this case is that what if you don't know the appropriate discount rate for a stock? And so you may want to rearrange this formula, and this is what you'll get. So this is used to estimate a stock's discount rate. It's broken up into two pieces. This piece is often called the dividend yield. And this is often called the capital gains yield. And the two of them put together provide us with a return to the stock that people expect in order to buy it. Or also we can call it the discount rate or the hurdle rate. All right, now the non-constant ones. What do we do with them? Okay, so here we go. A corporation currently pays no dividends, but it is expected. Now that means that maybe it's a new startup company. They don't have the money to pay dividends yet, but they're hoping to pay a dividend of 50 cents in 4 years. The dividend's growth rate is expected to be 10%, and the required return is 20. So what should we expect to pay for the stock? Now, if you drew up a timeline, you can see that 0 is here. So D4 is 50 cents. Now D5 is actually equal to D4 times 1 plus the growth rate. And that turned out to be 55 cents. So why does that matter? And by the way, that means the growth rate between year 4 and 5 is 10%. All right, so we're going to lean on this formula, which remember says that the price in any given year equals the next year's dividend over R minus G, which implies that P4 is D5 over R minus G. So our strategy is this. We could actually figure out all the remaining dividends by constantly multiplying them by 1.10, but we don't have to do that. And here's why. If you look at it carefully, if I were to sell the stock in year 4, look at this formula. I have what I need to know. And what this means is that if I sold the stock in year 4, I can expect to receive $5.50 for it. And so I don't actually need D5 anymore. I'm going to sell the stock here. So the price today must be the present value of those two cash flows. And since this is happening 4 years in the future, don't forget, the exponent here is 4. That's it. That's all the cash flows I have. I don't need to worry about D5 because P4 incorporates D5, D6, D7, et cetera, all the way out to D infinity. So I don't have to include it separately, but I do need D4. It's not part of P4. So I'll have 50 cents plus 5.50. And the interest rate we said before is 20%. And so that's 6 over 1.20 to the 4th, approximately $2.89. And so what you notice here is that we don't have all these dividends with a particular pattern. And in fact, we don't have any dividends at all in years 1, 2, and 3. So this is the so-called non-constant growth rate example. And it is a little bit messier, but it does work. All right, and then there's another example here. Let's look at this case. Here's 0. We're going to see a dividend next year of $1, $2, and $2.50 here. Then they'll grow at 5% per year. So that means D4 is 250 times 1.05, which is approximately 2.625. And the required return is 10%. So because the growth rate starts here, it applies between years 3 and 4. We have enough information to calculate P3, D4 over 1 plus R, 2625 over 1.10 to the first power. So this is the price we'd expect to pay in year 3 to buy the stock and all the remaining dividends. 2.386. All right, so we're going to bring all that together. Oh, wait a minute. Sorry, I just realized I goofed completely here. This is not right. It's supposed to be, that just brings it back 1 year. It's R minus G. Sorry, that's my fault. Let me fix it. R is 10%. G is 5%. So yeah, this is better. 2.625 is divided by 0.05, and we end up with $52.50. Okay, nice. Now, so I've gathered everything here. Remember, this is D1, D2, D3, and this is P3. These are both in the same year. I could have consolidated them into a single term, but I did not do that. So here are the present values, and you see they add up to $43.88. Okay, so in other words, in this case, because the dividend growth rate is not constant, I need to go through all these extra steps, and I end up with a price of $43.88. All right, now, if you go back to the beginning, we did mention 3 models. Price earnings method, which is really easy. Remember, we just multiplied the average PE ratio times that company's earnings per share. Dividend discount model, which we just finished, and now we save for the best for last, the capital asset pricing model. Now, we won't have time to get through all this tonight. We can just barely start it. But interestingly enough, with this CAPM model, it's a theory of equilibrium security returns. The developers of this model eventually won the Nobel Prize in economics. So that shows you how important this turned out to be. And it's a very streamlined model. It's designed to keep things as simple as possible, but it is based on a lot of unrealistic assumptions. So basically what it does is it introduces its own unique measure of risk, which you may have heard of, called beta. So if you've ever heard the word beta in the financial markets, they're referring to the risk of a stock, but it's a very specific kind of risk. So we'll discuss that as we go along. And so the beta represents how sensitive our stock's price is to changes in the overall market. So now in this model, we're going to make several assumptions, like I said, among them being that there exists what we call a market portfolio, which means you can buy all the assets in the economy with this one portfolio. It contains all of those assets weighted by their market capitalization. What does that mean? The market capitalization, let me just sneak this in here. the dollar value of all outstanding shares of stock. In other words, what you're doing is you're multiplying the price per share by the number of outstanding shares. Now, just to get a feel for this, I'm going to show you the company with the largest market cap in the United States. You can probably guess who it is. Well, if you can't, here it is. How about our old friend Apple? Look at this market cap, $2.43 trillion. That means if you multiply the number of outstanding shares by the price of $145.64 per share, that adds up to $2.43 trillion, if you can believe that. That's a lot of money, even for Apple. Now, closely behind them is Amazon, I believe, although it changes every day. Their market cap is a measly 1.855 trillion. Wow. Who else do you think is way up there in that list? How about Tesla? I bet they're lower than that. They haven't been around, only 644 billion. Wow. That's still a lot of money, but that's what market cap means. So if you can imagine all the stocks out there, we buy them in proportion to their market cap and put them together to create what's called the market portfolio. Now, since there is no such thing, we're going to use the Standard & Poor's 500 to represent our market portfolio. This is pretty common. If we don't have a market portfolio, we have to create one. So the Standard & Poor's 500 has the properties that are most closely resembling the so-called market portfolio. All right, now this is a fairly complicated model, I would say. So rather than trying to dive too deeply into this, I think this is as good as a place as any to knock it off. So I'll post the solutions from before, and then probably tomorrow I'll post the actual midterm, and then you can have a couple of weeks to do it. It won't take you anything like that, believe me. And then in the meantime, we'll get back into this next week. This is chapter 11. I think after this, we're all doing derivatives for the rest of the semester. So that should be fun. All right, anyway, so I guess we'll stop right here and I'll see you all next week.
Thank you, Professor.
Okay, all right, good night.
Bye, Professor.
Okay, bye.
Bye, Professor.
Bye.
All right, thank you, Professor.
All right, see you later. Bye.